While you were busy living your normal life, checking your phone, scrolling through social media, maybe worrying about bills or planning your next vacation, something happened, something quiet, something that most financial news outlets buried beneath headlines about celebrities and political drama. The rules of the market quietly changed. And here's the terrifying part. Nobody warned you. Let that sink in for a moment. The CME Group, one of the most powerful financial institutions on the planet, announced changes to silver margin requirements. To most people, that sentence means absolutely nothing. It sounds like boring financial jargon, the kind of thing you would skip over in a newspaper if newspapers still existed. But if you understood what those words actually meant, if you truly grasped the implications of what just happened, you would not be sleeping tonight. Margin rules are not complicated. They are simply the amount of money you need to put down to control a much larger position in the market. Think of it like a down payment on a house, except instead of a house, you are betting on the future price of silver. If the margin requirement is low, you can control a massive amount of silver with relatively little cash. If the margin requirement goes up, suddenly you need more money to hold that same position. And if you do not have that money, you are forced to sell. You are liquidated. You are out of the game. Now imagine this happening not to one person, but to thousands of traders simultaneously. Imagine the cascading effect of forced selling hitting the market all at once. Prices plummet, panic spreads. And by the time the dust settles, someone has made an enormous profit from the chaos. The question you should be asking yourself right now is simple. Who knew this was coming before you did? This is not paranoia, this is pattern recognition. Throughout financial history, margin changes have been used as precision instruments to reshape markets. They are not random, they are not accidental. They happen for reasons, and those reasons are rarely explained to the general public until long after the damage is done. By the time you read about it in the news, the positions have already been taken, the bets have already been placed, the outcome has already been determined. The silver market is not like the stock market. It is smaller, more volatile, more susceptible to sudden shifts in sentiment and liquidity. When margin rules change in silver, the effects are amplified. Small traders who were riding a winning streak suddenly find themselves underwater. They cannot meet the new margin requirements. They are forced to close positions at the worst possible time. And the irony is almost poetic in its cruelty. The very volatility that margin changes are supposed to prevent is often caused by the margin changes themselves. You need to understand something fundamental about how markets really work. The rules are not fixed. They never have been. The game you think you're playing today might not be the same game tomorrow. The goalposts can move at any time, and they usually move when it matters most. When retail traders start gaining ground, when small investors begin to see profits, when the balance of power threatens to shift even slightly away from the institutions that have always controlled the flow of money. This is not a conspiracy theory. This is documented history. This is how markets have always functioned. The rules exist until they become inconvenient for the people who write them, and then the rules change, quietly, efficiently, without fanfare or explanation. The question is not whether this will affect you. The question is whether you will understand what is happening before it is too late. Most people will not. Most people will wake up one morning, check their portfolios, and wonder why everything has changed overnight. They will blame themselves for making bad trades. They will assume they were simply unlucky. They will never realize that the game was restructured while they were sleeping. But you are still here. You are still watching. And that means you have a choice. You can continue living in comfortable ignorance, trusting that the system has your best interests at heart. Or you can open your eyes and start paying attention to the signals that the financial world is sending. Because those signals are everywhere, if you know how to read them. And the signal being sent right now through this margin change is loud and clear to anyone willing to listen. Something is coming, and the smart money already knows what it is. To understand what just happened with silver margin rules, you first need to understand who made the decision. You need to understand the CME Group, and once you do, you will never look at financial markets the same way again. The CME Group is not just another exchange. It is not simply a place where traders buy and sell commodities. It is the largest derivatives marketplace on the planet. When you hear about futures contracts, options, commodities trading on a global scale, you are hearing about the CME. They operate the Chicago Mercantile Exchange, the Chicago Board of Trade, the New York Mercantile Exchange, and COMEX, which is where precious metals like gold and silver are traded. In terms of sheer influence over global financial markets, the CME is arguably more powerful than most central banks. Let that statement settle in your mind. Every single day, trillions of dollars worth of contracts flow through CME platforms. Not billions, trillions. They handle everything from agricultural commodities like wheat and corn to energy products like crude oil and natural gas. They facilitate trading in equity indices, foreign currencies, interest rates, and of course, precious metals. If you have ever wondered who sits at the center of the global financial web, pulling strings that affect everything from the price of your groceries to the value of your retirement account, now you have your answer. The CME sets the rules. They determine margin requirements. They decide how much collateral traders must post to participate in their markets. And when they change those rules, the ripple effects are felt across the entire financial system. If CME sneezes, the global market catches a fever. That is not an exaggeration. It is a mathematical reality. Think about what this means in practical terms. The CME is not a neutral platform. It cannot be. Every decision they make, every rule they implement, every adjustment they announce has consequences. And those consequences are never distributed equally. Some participants benefit, others suffer. The differential is where fortunes are made and lost. The people who run the CME are not villains. They are not heroes either. They are administrators of a system that operates according to its own internal logic. Their primary concerns are risk management, market stability, and ensuring that the exchange continues to function smoothly. When volatility increases, they raise margin requirements to reduce systemic risk. When volatility decreases, they lower requirements to encourage trading activity. This is standard procedure. This is how all exchanges operate. But here is where it gets interesting. The timing of these changes is never random. Margin adjustments do not happen in a vacuum. They happen in response to market conditions, and market conditions are created by the actions of market participants, large institutional traders, hedge funds, investment banks. These entities have resources that allow them to anticipate changes before they occur. They have analysts monitoring volatility metrics around the clock. They have direct lines of communication with exchange officials. They have the ability to position themselves advantageously before announcements are made public. The average retail trader has none of these advantages. They learn about margin changes after the fact, usually when they receive a notification that they need to deposit more funds or face liquidation. By then, the damage is already done. The market has already moved. The opportunity has already passed. This is not corruption. This is asymmetry. It is the natural consequence of a system where information and resources are not distributed equally. The CME is simply doing its job, managing risk according to established protocols. But the effect of that risk management falls disproportionately on those who are least prepared to handle it. Consider the mechanics for a moment. When margin requirements increase, traders must post additional collateral. Those who have deep pockets can easily meet the new requirements. Those who are leveraged to the maximum, often smaller traders chasing bigger returns, cannot. They are forced to reduce positions or exit entirely. This selling pressure drives prices down, which triggers more margin calls, which forces more selling. It becomes a self-reinforcing cycle that can devastate a market in hours. The CME knows this. They have watched it happen countless times across different markets. And yet the system continues to operate exactly as designed. Because from the perspective of systemic stability, forced liquidation of over-leveraged positions is not a bug. It is a feature. It prevents small problems from becoming catastrophic ones. It protects the integrity of the exchange at the expense of individual traders who took on more risk than they could handle. The question you should be asking is not whether the CME is fair. The question is whether you understand the game you are playing. Because the referees of this game have their own priorities, and those priorities do not necessarily align with yours. Now we arrive at the heart of the matter. Why did the CME change silver margin requirements? What triggered this decision, and what does it reveal about the current state of the market? The official explanation is always the same. Volatility. When prices become unstable, when daily swings exceed normal parameters, exchanges respond by increasing margin requirements. This is risk management in its purest form. Higher margins mean traders have more skin in the game, which theoretically makes them more cautious and reduces the likelihood of cascading defaults. But volatility does not appear out of nowhere. It is created. It is the result of large positions moving in and out of the market, of institutional traders adjusting their portfolios, of macroeconomic forces converging on a single point. When you see volatility in silver, you are seeing the footprints of enormous capital flows. Someone, or many someones, are making massive bets on the future price of this metal. Silver is not like other commodities. It occupies a unique position at the intersection of industrial demand and monetary speculation. It is used in electronics, solar panels, medical equipment, and countless industrial applications. At the same time, it has been considered a store of value for thousands of years, a form of money that predates every government and every currency currently in existence. This dual nature makes silver inherently volatile. It responds to both economic fundamentals and investor sentiment in ways that more straightforward commodities do not. In recent years, retail interest in silver has surged. Online communities have formed around the idea that silver is dramatically undervalued, that the paper markets do not reflect the true supply and demand dynamics of physical metal. Whether this thesis is correct is a matter of debate. What is not debatable is that this retail enthusiasm has introduced new variables into a market that was previously dominated by a small number of institutional players. When new participants enter any market in significant numbers, volatility increases, prices become less predictable, the models that institutions use to manage risk become less reliable. And when those models start flashing warning signs, the response is always the same. Raise margins, reduce leverage, force the most vulnerable participants out of their positions. This is not panic, this is protection. But protection for whom? The hedge funds that hold massive short positions in silver have been under pressure. They have been waiting for an opportunity to shake out weak hands, to force retail traders to capitulate and sell at prices far below what they paid. A margin increase provides exactly that opportunity. Suddenly, the cost of holding long positions increases. Traders, who are already stretched thin, find themselves unable to meet margin calls. They sell, not because they want to, but because they have no choice. And guess who pays the price? It is never the institutions. They have the capital reserves to weather margin increases. They have sophisticated risk management systems that anticipate these changes and adjust accordingly. When margins go up, they are already positioned to benefit. They have hedged their exposure. They have reduced their vulnerability. They are ready. The retail trader, operating with limited capital and even more limited information, is not ready. They are caught off guard. They are liquidated. And when the dust settles, they are left wondering what happened. There's another layer to this story that rarely gets discussed. The timing of margin changes often coincides with significant market events, central bank announcements, economic data releases, geopolitical developments. It is as if the exchanges are anticipating volatility before it occurs, preemptively adjusting rules to protect against events that have not yet happened. This is not prescience. It is simply access to information and analysis that the average market participant does not have. The silver market is currently navigating extraordinary circumstances. Industrial demand is increasing as the world transitions to renewable energy. Investment demand is rising as concerns about inflation and currency debasement spread. Physical supply is constrained by years of underinvestment in mining capacity. All of these factors point toward higher prices. And yet, every time silver begins to rally, something happens. A margin increase. A sudden surge in short selling, a mysterious spike in volatility that triggers forced liquidations. Patterns emerge for those willing to look. The pattern here is clear. Every tool available is being used to manage the price of silver, to prevent it from moving too far too fast. This is not necessarily nefarious. Exchanges have a legitimate interest in maintaining orderly markets. But the effect is undeniable. The rules change when they need to change to produce a particular outcome. And that outcome rarely favors the small investor. Now, let us examine the casualties and the victors of this margin adjustment. Because in every market event, there are winners and losers. The distribution is never random. It follows patterns that become visible only when you know what to look for. The small trader, the individual investor who entered the silver market hoping to protect their savings or perhaps grow their wealth, is almost always on the losing end of margin changes. They operate with limited capital, often using maximum leverage to amplify their potential returns. This strategy works beautifully when markets move in their favor. It becomes catastrophic when conditions change. When margin requirements increase, these traders face an impossible choice. They can deposit additional funds to meet the new requirements, assuming they have those funds available, or they can reduce their positions, selling at whatever price the market offers at that moment. For many, there's no choice at all. The funds simply are not available. Liquidation happens automatically, ruthlessly, without regard for the trader's intentions or beliefs about where prices are headed. This is forced liquidation, and it is one of the most brutal mechanisms in financial markets. Your positions are closed not because you made a bad analysis, not because you misread the fundamentals, but because you could not meet an arbitrary threshold that was changed without your input or consent. The game was fair until it was not. Now consider the position of large institutional traders. They maintain extensive capital reserves specifically for situations like this. When margin requirements increase, they have the resources to meet them without breaking a sweat. More importantly, they often know these changes are coming before they are announced, not through illegal means necessarily, but through sophisticated analysis of volatility metrics and direct engagement with exchange officials on risk management policies. These institutions can use margin increases as offensive weapons. They know that when margins rise, weaker players will be forced to sell. The selling pressure creates buying opportunities. The smart money accumulates positions at exactly the moment when everyone else is being forced out. They buy the panic. They profit from the liquidations. And when the market stabilizes and prices recover, they sell into strength, harvesting profits that were created by the very rule changes that devastated smaller participants. Is this manipulation? The word carries legal implications that make it dangerous to use carelessly. What can be said with certainty is that the system produces outcomes that consistently favor those with the most resources and information. Whether this is by design or simply an emergent property of complex markets is a question that each observer must answer for themselves. There is a concept in market structure called legal manipulation. This refers to actions that, while technically within the rules, produce effects that would be considered manipulative if done by other means. Margin adjustments can function this way. They change the playing field in the middle of the game. They alter the cost structure for all participants simultaneously. And they do so in ways that disproportionately impact those with the least ability to adapt. The game is fair, by one definition of fairness. Everyone is subject to the same rules. But those rules can change at any time, and the ability to respond to changes is not distributed equally. A hedge fund with billions in assets under management experiences a margin increase as a minor inconvenience. A retail trader with a 5-figure account experiences the same margin increase as an existential threat. There is a bitter irony here that deserves acknowledgement. Margin requirements are increased during periods of high volatility to protect market stability, but the act of increasing margins itself creates volatility. Forced liquidations drive prices down. Falling prices trigger more margin calls. More margin calls force more liquidations. The very tool meant to reduce risk becomes a catalyst for the chaos it was designed to prevent. Who benefits from this chaos? Follow the money. When prices collapse due to forced selling, someone is on the other side of those trades. Someone is buying what others are being forced to sell. And that someone almost always has deeper pockets, better information, and a longer time horizon than the traders being liquidated. The rules always change at the most convenient moment. Not convenient for you. Convenient for those who write the rules and those who are best positioned to exploit them. This is not a flaw in the system. This is the system working exactly as intended. And until you understand this fundamental truth, you will continue to be surprised by market events that were, in retrospect, entirely predictable. So here we are, at the end of this journey through the mechanics of margin changes and their impact on the silver market. The question now is simple but profound. What does this mean for you? The volatility is not going away. If anything, it is going to get worse. The forces driving instability in precious metals markets are intensifying, not diminishing. Industrial demand for silver continues to grow as the world electrifies its transportation systems and expands renewable energy capacity. Investment demand fluctuates with sentiment about inflation, currency stability, and geopolitical risk. Supply remains constrained by the long lead times required to bring new mining capacity online. All of these factors create the conditions for dramatic price movements in both directions. And every time those price movements threaten to break out of established ranges, you can expect the rules to change. Margins will be adjusted. Requirements will shift. The cost of participating in these markets will increase at precisely the moments when participation might prove most profitable. This is not speculation. This is historical pattern recognition applied to current market structure. The market is becoming increasingly inhospitable to small traders. This is a trend that extends far beyond silver, far beyond commodities, into virtually every corner of the financial system. The advantages of scale have never been greater. Large institutions have access to better technology, faster execution, more sophisticated analysis, and deeper capital reserves than individual traders could ever hope to match. The playing field has never been level, and it is tilting further every year. This does not mean that small investors cannot succeed. It means that the strategies for success must account for the structural disadvantages that small investors face. It means understanding that you're not playing the same game as institutional traders. It means recognizing that the rules can change at any time and positioning yourself to survive those changes even if you cannot profit from them. The big money is getting bigger. Concentration is increasing across all financial markets. The largest players control more capital, execute more trades, and exert more influence over market structure than ever before. This concentration creates fragility. It means that markets can move violently when large players shift their positions. It means that volatility can spike without warning and persist without explanation. It means that the signals you rely on to make trading decisions may not mean what they used to mean. The scariest part of everything you have learned today is not that the rules changed. The scariest part is that they changed once. They can do it again. There is no reason to believe that silver margin requirements will remain stable. They will be adjusted, up or down as conditions warrant. And those conditions are determined by factors that you cannot control and may not even be able to observe. You are playing a game where the rules are written by others, enforced by others, and changed by others whenever they deem it necessary. This is not meant to discourage you from participating in markets. Markets remain one of the most powerful tools available for building wealth over time. But participation requires awareness. It requires understanding not just the opportunities, but also the risks. It requires recognizing that you are operating within a system designed by and for entities far larger than yourself. Knowledge is the only edge that cannot be taken away from you. They can change the margin requirements. They can adjust the rules of participation. They can move the goalposts whenever they choose. But they cannot take away your understanding of how the game works. They cannot eliminate your ability to recognize patterns, to anticipate changes, to position yourself defensively when conditions warrant caution. The changes happening in silver markets right now are not isolated events. They are symptoms of a broader transformation taking place across global finance. The old rules are being rewritten. The old certainties are dissolving. What emerges from this transformation is not yet clear, but one thing is certain. Those who understand what is happening will be better positioned than those who do not. You have watched until the end. That puts you ahead of most people, who will never seek out this information, who will never question why their positions were liquidated or why prices moved against them. You have demonstrated a willingness to look beyond the surface, to understand the mechanics of power in financial markets. That willingness is rare and valuable. The game is changing. It will continue to change. The only question is whether you will understand the changes as they happen, or only in retrospect, when it is too late to do anything about them. If you want to understand the game before it changes again, subscribe now, because the next time the rules shift, you will want to know about it before everyone else.